This is a chocolate bar. The cocoa inside it costs about 6 cents. When the price of that same cocoa quadrupled to a record high, the company that made this bar didn't lose money, it made more, and I'm going to show you exactly how. Here's the fast version. Cocoa futures on the Intercontinental Exchange climbed from around $4,200 a ton in late 2023 to an all-time peak of $12,931 a ton by December of 2024, according to Bar Chart, more than tripling in about a year. That kind of shock should crush a company whose entire product runs on that one ingredient. Instead, Mondelez grew revenue 5.8% to $38.54 billion in 2025. Lindt and Sprewangli posted its best organic growth ever, 12.4%, in that same stretch. Nestle pushed confectionery pricing up over 10%. The raw ingredient exploded, and these companies didn't just survive it. Several of them had the best year in their history. My honest take on that is simple. Cocoa being cheap was never a happy accident these companies stumbled into benefiting from. It's the entire foundation the business runs on. A study cited by Marketplace found a Hershey-style bar cost somewhere around 21 to 29 cents to actually make, and mass-market bars like Hershey's, M&M's, and Snickers run at least half sugar by content. What you're really buying is a branding and packaging business wearing an agricultural costume, and cocoa sits inside it as a nearly disposable ingredient. Farmers themselves receive roughly 6% of a typical bar's retail price. So when cocoa quadrupled, it wasn't gutting the core of the business at all. It was squeezing the one input that had already been the cheapest part of it to begin with, which raises the obvious question. How do you grow revenue while your key ingredient costs 4 times more? That answer starts somewhere most people never think to look, in how far ahead chocolate companies actually buy their cocoa. Hershey doesn't wait until the week it needs beans to go buy them. These companies lock in prices 6 to 12 months out through futures contracts on the ICE exchange, a practice known as hedging. Then Hershey CEO Michelle Buck told CNBC around February of 2024 that the company has a hedging strategy to manage the price volatility. Rabobank analyst Paul Jules laid out exactly why that mattered at the time, explaining that the large chocolate companies were well hedged last year and did not have to immediately pass on high prices to consumers, though he added there is only so much the industry can do to absorb costs over the long run. What that meant in practice was that while the spot price spiked toward nearly $13,000 a ton, plenty of these companies kept paying something much closer to normal prices, locked in months before the spike ever hit. Here's the thing though, hedging alone does not explain everything, because those older contracts eventually run out, and by 2025, the higher costs finally caught up to the big players hard. Hershey's gross margin dropped from 47.3% down to 33.5% for the full year, and net income fell 60.2%. Mondelez lost more than 10 percentage points off its gross margin, with diluted earnings per share down 44.7%. The mass market companies genuinely took real damage to their margins. No argument there. What is strange is that their revenue kept climbing anyway, because they simply raised prices to cover the gap. Mondelez's own CEO, Dirk Van de Put, put it plainly in the company's fiscal year 2025 results. While unprecedented cocoa cost headwinds impacted our profitability, our teams remained focused on what they can control. What they controlled, in the end, was the price tag on the shelf, and nobody proves that point better than Lindt. While Hershey and Mondelez absorbed real margin damage, Lindt raised prices across its entire portfolio by roughly 19%, and instead of shrinking under that weight, it posted the best organic growth in company history, 12.4%. Here's my take on that. Lindt is the tell. When the single worst cocoa year on record produces a company's best ever growth, the raw material was never actually the constraint everyone assumed it was. That's proof the price of chocolate has far less to do with the price of cocoa than most people think, and far more to do with what a brand can get away with charging. But there's an even stranger layer to this story, one that goes beyond simply raising prices, and it involves Hershey acting less like a candy company and more like a trading firm. In January of 2025, reporting that traces back to Bloomberg found Hershey sought approval from the Commodity Futures Trading Commission to take delivery of more than 90,000 metric tons of cocoa through the ICE exchange, roughly 9 times what the exchange normally allows a single position holder to hold, sitting well above the federal position limit of 49,000 tons. That's not a chocolate company simply buying ingredients anymore. That figure was roughly equal to every single bean certified for delivery in New York at the time. My honest opinion is that hedging quietly turned these chocolate companies into something closer to commodity trading desks. A candy company doesn't need to chase 9 times the legal cocoa limit just to keep the assembly line running. That's the behavior of a firm actively playing the futures market itself, not merely protecting its supply chain. If you're finding this useful, hit like and subscribe. It genuinely helps a channel like this reach more people, and there's plenty more of these breakdowns coming. While all of that financial maneuvering played out at the top, something very different was happening at the very bottom of the supply chain, where the actual cocoa comes from in the first place. Roughly 5 to 6 million smallholder farmers grow the world's cocoa, concentrated mostly across Côte d'Ivoire and Ghana, which together account for around 60% of global supply. You'd assume record high prices in late 2024 meant a windfall finally landed for these farmers. It didn't. Both Ghana and Côte d'Ivoire set their farm gate prices, meaning what farmers actually get paid, months in advance through their own government bodies. So while cocoa traded above $10,000 a ton on international markets, farmers were still collecting payments locked in at prices fixed long before that spike ever happened. Research cited by Ricolto found the average farmer in cocoa growing regions of Côte d'Ivoire earns only around 45% of what counts as a living income, with 94% of surveyed households falling below that benchmark entirely, and a third of them sitting below the extreme poverty line. My honest opinion is that this might be the cruelest detail in the whole chocolate story. When cocoa hit its highest price in recorded history, the people who actually grew it still didn't get paid more, because the system setting their prices is built specifically so they can't capture that kind of spike. Even certification programs designed to close this gap haven't managed it. Fairtrade's own past impact reporting found its premium generated only around $36 per year per individual member, an amount the organization itself called small. Research out of Maastricht University put it even more bluntly, stating that of the fair trade premium baked into a certified product's price, currently only a few percent actually reaches the farmer. Meanwhile, back on the retail side, there's one more lever these companies pull that has nothing to do with cocoa prices whatsoever: timing. According to the National Confectioners Association, 4 big candy seasons, Valentine's Day, Easter, Halloween, and the winter holidays made up 62% of all U.S. confectionery sales in 2024, inside a $54 billion industry. Winter holidays alone brought in roughly $7.5 billion. Halloween pulled in about $4.6 billion in candy sales on its own. And Easter week specifically stands as the single most lucrative week of the entire year for candy, at roughly $823 million in that one week. My take here is that these companies didn't just get lucky people happen to buy candy around the holidays. 62% of a $54 billion industry concentrated into 4 windows a year isn't tradition quietly working in their favor. It's a business built and engineered around those exact windows, with premium packaging and shelf placement specifically designed to maximize what people spend once they're there. That engineered demand runs headfirst into another quiet cost-saving trick sitting right alongside it: shrinkflation. Mondelez cut its Cadbury Dairy Milk sharing bar from 200 grams down to 180 grams in March of 2022, a 10% reduction, while holding the price steady at £2. It wasn't even the first cut either. That same bar had already dropped from 140 grams to 120 grams back in 2011. BBC economics editor Faisal Islam described the pattern bluntly at the time: noting that, in the Roman army original sense of the word, the Dairy Milk 200-gram bar has been decimated. Toblerone pulled a similar move in 2016, widening the gaps between its triangular peaks to quietly cut roughly 25% of the bar's weight without touching the price on the shelf, a change that became infamous online as the Brexit Toblerone. Public backlash eventually forced a reversal in 2018. So, back to where this all started. This is a chocolate bar, 6 cents of cocoa sitting inside a product that's mostly sugar, sold by companies that lock in prices months ahead, raise prices even harder whenever they can, occasionally try to buy up 9 times the legal limit of a global commodity, and squeeze extra margin out of holidays they've spent decades engineering into ritual. Meanwhile, the people actually growing the bean at the very bottom of that chain barely felt the record prices sitting at the top of it. From the outside, the 2024 cocoa crisis looked like the worst possible year this industry could face. From the inside, for several of these companies, it turned out to be one of the best. Subscribe if you want more breakdowns like this one. And if you're curious how TV brands actually make their billions, that video's right here. Go watch it.